Hi, and welcome back to Channel 11. I'm your host, Ken Shinoda. Today is Thursday, May 1st, and we're going to talk about April Angst. It's like if you had just gone on vacation, didn't look at your Bloomberg, didn't look at your phone. It's almost like nothing had happened because equities have reversed most of their losses. I think the S&P as of yesterday was slightly down. Maybe it's even slightly up month over month now. And the NASDAQ, not negative returns on the month, I don't think. But let's take a look. So the land of gains has kind of gone sideways. I guess it was a big dip. Max drawdown was 18.9%, just a little over 1% shy of the 20% bear market. Now we sit about down 9% from the highs. A lot of it on concerns around growth, concerns around the tariffs and what that can mean for future growth. So we see a downgrade of GDP forecasts across the globe, really. Some of the places that would be more hit by the tariffs, like Mexico, seeing to have dropped the most. And what we saw first was the soft data really rolled over. So all the sentiment data has gotten really negative. In some instances, it's actually at or below levels during COVID, and you would think that was a really bad time. And here we are where at least it seems like the public out there is thinking that things are just as bad as they were then because there's just so much unknowns out there. And maybe they see prices already going up. My wife buys stuff for the kids sometimes off of Temu, and prices have doubled, if not tripled, off some of those Chinese discounter websites. So the hard data, we got manufacturing PMI today. It has been weak. Sub 50. We saw a brief blip above 50, but it's been kind of weak for the last couple of years. And the real big question to me is that services PMI. So if that kind of plays catch up with the soft data and shows weakening, then that's a sign that the consumers are truly pulling back meaningfully, which would mean a further pullback in spending. And that's really where the economy is being driven right now, is by that services sector. So let's keep an eye out on that. The last prices paid data didn't come in too great. That also has to do with a lot of front loading in fear of the tariffs. And so paying up for getting that inventory in. That's why you saw GDP negative, was the pull forward of purchases and the big trade imbalance that we had in Q1. Looking at employment, this is ISM employment, also on the weaker side. Now, this is obviously bad for economic growth, but this is good for inflation. This kind of will help the Fed ease, which will be good for markets, I think. And so we want to continue to see weaker employment prints on from a wage standpoint, because we want to make traction on that inflation number. Another sign that's good for inflation, but possibly bad for the economy, is the job openings. You can see job openings are now at the lowest level they've been since maybe 2021 here. And you can see that's around 7 million. We got all the way up to about 12 million. And so this is actually maybe a good sign for inflation, but bad sign for the economy. And so we need to focus on jobs data. ADP came in kind of weak. Companies pulling back on hiring because of the uncertainty. So really the big question, does that lead to a recession, or does that maybe just lead to a slowdown while this uncertainty exists? Kind of like what we saw in 2022. You had a couple quarters of weak data. One was barely positive, another negative print. So that's kind of my base case now. I'm definitely one of the less bearish people at the firm. I think that uncertainty will have consumers pull back. You're going to see companies already pull back. It's going to slow growth for sure. Rates are coming down on that, I think. But I still can't guarantee that we have some deep, dark recession coming because a lot of this tariff stuff could get pulled back by the administration. So I'm in kind of a defensive mode, but wait and watch and see how that data comes through and see really kind of how this tariff thing plays out. Now let's look at the Mag 7. Max drawdown down 30. It's recovered some of that, down 20%. You had Microsoft came out with some good earnings yesterday. That's helped buoy the markets. Looking at the S&P market value versus equal weight index, you saw that we saw the S&P market value kind of underperforming, but now it's been going sideways. And with this recent move in tech, it's now playing catch up to that equal weight, as that tech has been kind of the leader very recently. Our speculative fervor monitor, Bitcoin holding in there. I think Bitcoin, it's less speculative than it used to be. It's more widely adopted. You got the ETF thing going on now. It's now a substitute for gold. So really, it's kind of these, these Doge coins, these fart coins, or whatever people call them, that seem to be where the more speculation is. Dogecoin over there on the top right, you can see having collapsed. It's kind of a little stabilized, but pretty big move down. ARK on the bottom left-hand side, and then Tesla on the right. So the markets broadly have kind of settled down here. You're not seeing the same type of collapse out there. But let's watch these. I like to, I think we nailed the top in some of these markets, noting that they were turning over. We've watched them fall, and now we need to acknowledge that things have stabilized for now, and then and reassess. Semiconductors, peak AI frenzy, and then DeepSeek happened. We've seen a 32% drawdown there, gained back a little bit of that, but not nearly as much as some of the other markets we just looked at. Keep our eyes out for semiconductors as well. So now we look at the Trump trades. Coming out of the election, small caps were on fire. People thinking that there's going to be all this deregulation and lower taxes for corporations, and we've seen a big pullback in small caps. A little bit of a recovery here. The 10-year Treasury also marched higher as the fears of tariffs, which turned out to be good fears. The fears of tariffs would lead to higher inflation. But now people are wondering maybe tariffs are deflationary. And we talked about that on a couple Channel 11s that, it's a one-time inflation pop, but then it's going to decrease global trade. And that's not positive for economic growth. And the markets are obviously sniffed that out with the correction in equities. So rates kind of calming down a little bit. The Trump trade kind of changes. It was, long small caps, long dollar, American exceptionalism, to all of a sudden it's flipped to sell USA, because there's going to be a movement of capital out of US dollars into other places, people bringing their money back onshore. And I definitely think there's some of that happening. But I think, we maybe will take a pause here. So some of these moves that we're seeing across the board, I think are going to calm down. US dollar being one of them. We've seen a big move lower underneath that, just below that psychological $100 level. And I think we're going to look at a long-term chart later that I think we're going to stabilize a little bit here, maybe even retrace some of that sell-off in the dollar. So I wouldn't be chasing the short dollar trade anymore. Okay, equities. This chart looked really different. We made this about a week and a half, 2 weeks ago, and it looks really different because a lot has recovered. So now you can see on the month, Nikkei up, MSCI emerging up, Europe on the left, FTSE, Eurostock 600, barely down. Year-to-date, positive on the year. NASDAQ flat on the month. Isn't that amazing? S&P only down 1%. I think after today it'll be basically unchanged from a month or so ago. Down 5% on the year now only. And Nikkei down 8, NASDAQ down about 10. Really the small caps getting hit the hardest there, with the Dow Jones down 11 to 13%. We had been following the movement out of U.S. exceptionalism into international equities. You saw this run up in international equities, but when the U.S. goes, so does the rest of the world. There was nowhere to hide. Markets sold off everywhere, and you can see that they're also recovering. So a really big recovery in emerging markets, especially that had lagged both developed Europe and U.S. Also, big recovery rallies across the board here. You see FTSE 100 in the top right. I mean, basically like nothing happened. Pretty amazing. Sometimes when you go on a long trip, don't look at your phone, and it's amazing how much stress you can keep from yourself by not staring at those markets every day. All right, make Europe great again. It was working, and then it stopped working, and you've seen that pull back again. We saw this on the other page. So a little bit better entry point into getting into Europe. But if you're a bear, I have to say, if you're negative on the U.S., the U.S. is a big driver of global growth. We're a big buyer of stuff. And if we're buying less stuff from these other countries, if we're buying less BMWs, if we're buying less cars out of Japan and other places, I know this is the Europe index, but that's going to be slowing of growth globally. Will these other equity markets perform just based on valuation alone? Right? I mean, eventually earnings have to catch up. Here's a longer term chart of the dollar going back to 2020. And you can see that key level here around that $100 area where every time we've gotten down to it, we've bounced. So I'm not saying we're going to bounce and go back up to that 110, 112 area again, but I do think that we probably find a little bit of support here. Also, equity markets have recovered. So I think this kind of sell America trade has lost a little bit of steam. Another great chart we've been looking at. It's remarkable how similar it is to the first administration, with the euro having weakened into the election and then rallied after. And it seems like it's on the same path. And I myself personally have been buying some yen, euro, sterling, really just for not necessarily because I'm going to try to make money on it, but like if I'll go on vacation, I want to hedge some of this potential dollar weakness. Dollar's strong right now, and some of these other currencies are historically cheap levels. So yen also hit a critical level, as you can see. It's kind of in that cheap zone around 150 plus, got all the way to 160. And, we're bouncing off this kind of like 140 level. So I think, as the dollar bounces, the yen probably sells off. This is inverted. So when the line goes up, the yen is selling off. Commodities, kind of a mixed bag. Slowing growth, hurting some pockets of the market. Energy had been weak, for example. But then you got gold, which has been on a tear as a safe haven, although it seems like gold has been pulling back very recently. So as we look at the charts, one of the best performing assets this year, gold, up 25%, and we're only at the end of April. Pretty remarkable, up 5.7, even with the pullback that we've seen from recent highs. But then things like natty gas, down 21% on the month. Energy now on the far right, I noted that there was weakness in energy related to kind of slowdown in global growth and also excess supply. So you've got this kind of mixed bag of performance across the commodity complex, with really precious metals leading the charge. Looking at yields, a lot of vol, and we're not much has changed outside of the front end. In many of the longer duration parts of the market, 10, 30-year treasuries are basically almost unchanged from a year ago. It's really only the front end of the curve that's fallen as the market is pricing in Fed cuts. Bessent today just came out, said that the 2-year is suggesting that the Fed should cut rates. So that's something Jeffrey says a lot, is the Fed should just follow the 2-year, and the 2-year sniffing out that slowdown. But I don't think the Fed's going to cut. We got a Fed meeting next week. I think that they've been so adamant about fighting inflation and that they're going to stay on hold. So I think it's going to be a rather boring meeting. I think they're going to acknowledge the fact that the labor market data continues to weaken, and that may give them a pathway to further to cut sooner than they have thought because of the weakening in the labor market. I think they're going to talk about it because you've seen some of the data come down, like that job openings, the ADP report I talked about. Let's see how things shake out towards the end of this week. Steepening of the curve continues. There's definitely room for the front end to fall with Fed cuts. And then the long end, you want to be underweight that because of fiscal uncertainties. And the long end has been underperforming. So having a steepener bias has definitely been the thing to do. So fixed income returns, kind of all over the place in April. Duration turned out to work ever so slightly on the far left. You can see Treasuries up 60 basis points, agency CMBS up 1%, non-agency CMBS up 1%, ABS up 50 basis points. But then risky credit kind of unched, and it was down mid-month because spreads had widened. High yield got up north of 400. I think it was north of 450 at one point. Now we've settled back into kind of the mid to high 300s. And talking to our bank loan trader today, market's bid. So market is in recovery mode along with the equity rally. And I think people were off sides for this move, and especially in equities. I think there was a lot of de-risking, a lot of deleveraging, and people thought things were going to get worse. And of course, when you do that, the market rips in your face. And that's the challenge with the land of gains. Now, year to date, the S&P 500 fixed income is doing well with equities down. So, I know there was some challenges in volatility in fixed income, but broadly speaking, even the riskiest stuff, look at levered loan triple Cs, you got positive returns. So diversification from equities is working. We've talked in the past about credit being a replacement for equities when it's yielding 6 to 7%. Over the long run, you can generate similar long run equity returns using fixed income, and I think that's That playbook has shown to be a good thing this year. But the lower the risk, the longer the duration, the better the asset's done. On the far left, securitized sector is also up about 2 to 3%. Really, corporate credit got hit a little bit harder during the sell-off because those are names that are more exposed to the tariff uncertainty. Whereas, if you have a residential mortgage-backed security, people paying their mortgages, tariffs don't really affect. Maybe it can affect their job, but if anything, higher building cost and lack of immigration makes replacement costs higher. You have less homes being built, which will be supportive for housing and positive for the performance of that credit. Now, this is a fascinating chart because if I just showed you this a week ago, half the stuff on the bottom was red, negative returns, year-to-date performance. And with the rebound in equities and the rebound in rates coming back down and spreads tightening, triple C levered loans, positive return, triple C high yield, negative return, the lone wolf there after having a great run for a couple of years, high yield. So we'll have to wait and see. The spreads never really widened as much as to the point where it was a screaming buy opportunity. Things kind of cheapened up. Top of the capital structure, IG was out about 20, 25 basis points. Top of the capital structure, securitized was out maybe 25 to 40 basis points. Bottom of the capital structure was out, call it anywhere from 40 to 75 basis points. So spreads widened, but they never got to levels anywhere close to 2023, October of 23 at the peak in rates. Spreads were really wide then. And so we were on kind of like excited on watch, hoping that we get more of a follow through in equities, which would give us a buying opportunity in credit. And it didn't really materialize. So now the market feels pretty firm and people that have been hoarding cash are putting money to work, and that's driving spreads tighter. So what's the market thinking? Well, it's been all over the place. Higher for longer, Fed's going to cut, higher for longer, Fed's going to cut for the last couple of years. And we're in Fed's going to cut mode right now. And the market does think that the Fed's going to start. They're going to start in the summer. And we're going to cut. At one point, we got to 4 cuts. That's probably backed off a little bit with the rebound in equities. But, I think that it all depends. Like if growth rolls over, that gives them a pathway to do so because maybe the growth worries will outweigh the tariff and inflation concerns. But the way they've been speaking, 4 cuts is definitely not in their rhetoric right now. We'll see if that changes with Powell. Break-even inflation rates, there was a moment of extreme fear. You saw 2-year break-evens break to the upside. Longer-term inflation expectations remained rather anchored. And now you're seeing those 2-year break-evens come down again. So that's I guess that's good for the Fed. Here are those spread changes we talked about with the bottom of the capital structure seeing the most widening and really corporate credit getting hit harder. And part of it has to do with flows. We didn't really see the outflows. Outflows, I think, can sometimes be a more meaningful driver of spreads. 2022, 2023, we saw a lot of spread widening, and a lot of it was just driven by flows. Everyone was selling, and there was also a new issue hitting the market, and there wasn't money coming into the pools of capital to buy these assets in a meaningful way. And now there's some money coming in, and you didn't see outflows in that 1 week when equities were down the most. And so you didn't see as much spread widening as we experienced in 2023. Here you can see the magnitude of that. High yield got into the mid to high 400s, it looks like, and then now it's back down kind of 384. IG could be sub 100 by the end of next week if it continues at this path. I think, again, a lot of it depends on that hard data. So what's cheap report? One of my favorite slides. We look at it every month. Hope you guys enjoy it as much as I do. Things are looking much better. A couple months ago, we didn't even have 90 to 100th percentile because nothing was in that zone. And then the chart, the y-axis went all the way to 0 because IG high yield, EM corporates, AAA CLOs, BBB CLOs, and I think also short corporates were all, maybe not short corporates. Everything was, those indices I mentioned were all down sub 5th percentile. At one point, high yield and IG were both 1st percentile, only more expensive 1% of the trading days. And with the recent backup in spreads, things are definitely more averagely valued or fairly valued. IG has had a little snapback, so it's still not, I don't think, cheap, but it's definitely better than it was. And the securitized sectors are, I think, back in cheap mode especially CMBS, RMBS, and agencies, of course, north of 90th percentile. Current coupon agency spreads about a week ago got to 17-month wides. So interesting entry point because rates were also higher then too to get into agencies. So there's value to be had in fixed income. You got to pick and choose your battles and diversify your risks. I think that is something good for everyone to think about in their portfolios, is that diversification. We'll just have to wait for that data to come through. So thanks for watching. We'll catch up next month, and we'll see if we go higher or lower. It's going to be an interesting month, I think.